The following is a presentation of TFNN.
Good afternoon, folks, and thanks for joining me. This is our normal webcast edition, and we've got a lot to get through. I will try to save time at the end for some additional Q&A, so I do see some questions in there, and I'll do everything I can to get to that as well. I want to thank everybody for sending me the questions that they did ahead of time, and I certainly want to be able to cover that. And so we'll just go ahead and get started as we're starting right now. The markets are relatively flat, hovering around zero. You got the Dow's down 3 points, S&P 4. Composite down 16, and this is one of my favorite slides here because it shows all of the different types of markets that are out there, and the volatile market, bear, bull market, and so forth. And we're certainly in for a volatile ride here for quite some time. We are coming in into this Saturday into the full moon cycle, full moon lunar eclipse. And so these are some of my favorite pictures supplied to us by one of our clients, one of our subscribers here. Today is we've got for the rest of the year. Today's the 7th, and we've got one more webcast for the year, which is going to be on the 21st, which is Wednesday. You've got Christmas and Christmas Eve following, I guess, on the weekend. I was just paying attention to it today. So, I don't see any reason why we will change the Wednesday webcast, although I know a lot of folks will be traveling and so forth. But obviously these things are archived, and we do have a new moon that is coming in on Christmas Eve. So we will go ahead now. I'll publish a schedule. We do this every other Wednesday, and I'll go ahead and publish the dates for 2012 when we are together on December 21st. But you can expect it'll be 2 weeks after that on the 21st, which would actually take us to January the 4th. What we do, one of the elements of our systems that we use, I do use the New American Ephemeris. Here is the publishing. It's published by Starcrafts Publishing. Here's the phone number for you, and I do recommend that you get one of these. These are great to have to be able to take a look at. If you do take a look at lunar or astro cycles that are out there, the Daily Aspectarian is this portion right here. This is the top half of the ephemeris of one page. This is the bottom half here, and the bottom half is dealing with, on a daily basis, what aspects are occurring, major, minor, and so forth. These are the lunar phases that we go through. I'm rolling through this relatively quickly. Anybody who's a new subscriber, please go back to the old archive webcast, especially the very early ones where I spend more time going through the lunar phases, and we like to just keep raising the standard and keep moving a little bit higher. These are the major aspects that we review inside the ephemeris. We're really taking a look at these 5 primary angle alignments between planets. There are plenty of other angles that are out there. These are the ones that seem to have the most impact on markets, and sometimes it's on different markets. Sometimes it's commodity versus stock, or currency versus commodity and or stock. With regard to the December dates that we're dealing with, right now what we're dealing with, and here's a list of dates for the rest of the year, going ahead and taking us through January 2nd. And so what we are dealing with here is this coming Saturday. I might have said Friday. This coming Saturday, if you will, where we have a full moon lunar eclipse. And then on the 18th, we have, and I've been following 6 primary lunar phases, and we'll see that on the charts. They've been behaving pretty well at identifying tops or bottoms, so they've been good at identifying support and resistance, and those being the first quarter, third quarter, new moon, full moon, apogee, and perigee. So coming up, we've got the full moon coming in this weekend. Whether Friday or Monday is the turn date is hard to say at this stage, and this is not certainty, but you'll see when we take a look at the chart that these have been working very well. Then the following week on Sunday, you've got a third quarter moon, and then on Thursday, you've got the moon at perigee. So those are the lunar phases for the remaining part of the year. This here is a blow-up, if you will, of the SPY chart with the daily lunar phases on them. And what we can see is, again, that these have worked fairly well as identifying support and or resistance here. This new moon solar eclipse, this is the cycle that we're in right now as we came back from the Thanksgiving Day weekend, and this was taken earlier this afternoon. If we took a look at the chart right now, it's really not much different than where we're at. And I've covered this in the newsletter with regard to the first quarter moon here and how this top has actually acted as a pretty decent resistance point. I do have the red line that we've got here. This is the October 27th swing high. I don't know why this red line. This is supposed to be over here. I don't know why it didn't actually copy. But you can see the volume as the SPY has come up into that swing point. And we covered this in more detail during our last Wednesday webcast when we were taking a look at swing points and volume coming into swing points. In this case here, we had a rejection on that first quarter moon. This is the day where we went ahead and took our short positions in the SPXU and the ERY. We can see the following day, it did close up into it on light volume. It did close up into it yesterday as well. This morning or today, we are trading below this area. So no volume coming up into it. And whether or not it will gap up to test the top like the Dow did, remains to be seen. We obviously have a couple more trading days going into this full moon cycle that we have here. And I'll continue to update this in the newsletters. With regard to major astro events during the month, and some of you trade different vehicles, if you will. Here are all of the major astro dates that are occurring. What we do have on Saturday as well, there are really a couple of them, which we will see in a moment. You do have the Uranus going direct on Saturday, and these, again, are just simply all of the major angles, if you will, and those, again, coming back here to these five areas that or five angles between planetary alignments that we take a look at as potentially having an impact on the market. So here is all of December for you if you wish to investigate that further. One of the other things that's occurring on Saturday is a planetary index date. This, again, is the list of distributions of planets that are just simply aligned on each day. And this information, folks, is in the daily Aspectarian. This is in the bottom half of the Aspectarian. This is not for the current month, but you'll see each day here, Monday, Tuesday, Wednesday, the first of whichever month this was, might have been July or what have you, identifies how many planets are there. You would normally count these by hand. Obviously, what I've done is I've automated the process and gone back to 300 years to study 300 years worth of data, 1800 to 2100, to understand how often what quantity of planetary dates occur each day, and then have found and this is the work that was originally done by Larry Pesavento and Ruth Miller, and what I've just simply done is digitize the data so that I can drop it in on charts and that we can study it. When you have, in this instance here, what we know that we're dealing with right now, that October 27th happens to be a 17P index date, 35 of those events here in a 3-year period of time. So we believe that that is a major high. If that high is taken out, then we will seriously have to look at going along these markets, but not until that high were to be taken out. And what we do have occurring right now on Saturday as well is the following. And here I've provided you an entire table. So this is a new table that I'll continue to put in for each month, each webcast that we do. And see, since I have this data digitized, the work that was originally done by Larry and by Dr. Ruth was taking a look at ET stands for ephemeris time. ET old happens to stand for the planets that were inside the ephemeris at the time that Larry and Ruth and a few others did their work. Since then, in the New American ephemeris, there are other planets that are in there like Chiron, and so there's now new aspects if you're to take a look. And so the work, when I do my work, I try to do my work as a reference point against the work that was originally done. And that original work was coming back here and taking a look at this column right here. ET, ephemeris time original, meaning the original work. P, really standing for Larry Pesavento, but also we use that as a planet, if you will. So P for Planet Index Dates. EST is standing for Eastern Standard Time. Because I have the information digitized, I'm able to back it up to Eastern Standard Time, which is a 5-hour time zone difference. I don't adjust for daylight savings time or anything along those lines. And I'm still continuing to do work on the Eastern Standard Time and applying that to charts to understand if there's any benefit or not. What you can see here is actually I had been focusing on just simply the Eastern Standard Time using the old aspects, and you can see that on the 10th also you would have 3 planetary index dates. I actually didn't map out the 4 as I was doing my work yesterday. Didn't realize until I updated this chart, quite frankly. And what you're going to find is that in the work that I've done using Eastern Standard Time, the old aspects, and I'll run you through those charts here, and I'm going to come back here, but Eastern Standard Time with the Eastern Standard Time with the original aspects, old aspects, if you will, you can see I've unhighlighted that. That occurs 2% of the time, which, when you take a look at the distribution of days here, you would think it would have an impact. But just simply on the work that I did, and I don't have all the charts in here posted, but you'll see as I go through them, I could not identify where there was almost more of a flip of a coin. Didn't seem to matter, and so I've backed that out, at least from the Eastern Standard Time, with regard to the 3 P index dates. I will, before the weekend, run my charts using this, which is using. Let's see, I was using the Eastern Standard Time with new aspects with 4. Why would there potentially be a difference? Well, there potentially be a different because Eastern Standard Time with 4 aspects, in this case here, only occurs 1.4% of the time versus this being 2.3% of the time. 1540 versus 23. In this case here, the work that Larry and Dr. Ruth had done, they took a look at 3 and less or 14 or more alignments that occurred on any single day. And so let me get right to those charts. So you'll have this information here handy for you each month so that you understand, what is occurring and when. If we take a look at the original charts that I did, the most recent 3 planetary index days that we have is on July 29th and July 31st. This didn't occur at a high or a low, if you will. We then had another one here on April the 9th. That occurred neither really at a significant high or a low. If we go back further, we take a look at January of 2011. We have one that occurred on January 3rd, one that occurred on January 1st. Again, nothing you can see kind of mid-stroke, if you will. We had another 2 on the 22nd and the 24th here. You would have thought there would have been some type of significant strength in here. It's possible you could take a look at this as perhaps putting in a low here. This one here on the 17th did have an impact for several trading sessions. But again, you can see as you go back and you take a look at these, there was nothing here, and now you're going to see me flip through some charts here. Continue to flip through some charts. August 5th there was some type of impact here, maybe just for a few days. This is ending up in the middle of the stroke, if you will, the middle of the move here, nothing but going sideways. We did have some impact back here, May 1st, 2010, but there may have been other things going on. So you can see as I've discounted the reliability of just simply solely focusing on a 3 planetary index date, just based on the initial work that I did. I took this back where to here's 2008, if you will. And if we go back one more chart, I believe there was one more chart in 2008. Maybe this is this final chart here in 2008. I really didn't see anything that would be reliable. Certainly nothing as reliable as going and taking a look at this chart here, this lunar chart, which has really identified for us in many instances a turn in the marketplace, whether it was any of these 6 aspects that we use. Again, first, third, perigee, apogee, and full and new moon. So I'm going to go ahead and move on, and as I say, I will do some work and study the 4 planetary index dates using the new dates and see if there's anything there. If there's anything there, I'll report back to you. If there's not, you'll know that there wasn't. We'll just kind of leave it as that. there have been a number of questions, and so I wanted to be able to get to that, and then we'll also open up the floor here for some additional questions. So the questions that have come in are as follows. So Glenn provided a question with regard to the webinar today, taking a look at a 3-gap play and the 3 drives pattern, and so and also was looking for some more information on currency pairs. So I probably won't get too much into the currency pair piece of it, at least right now, but I do want to go ahead and we'll take a look at the 3-gap play, and I want to get to each of these questions here. And again, what I would like you to do for the upcoming webcast, how I would like to be able to use this part of the time is if you do have some questions, please send them to me ahead of time. I'll do what I can to find some charts or get information so that we can all review it and use this as a way for some additional education. And always you can go back to these webcasts anytime to take a look at it. So you can see the different questions that are up here that folks have asked. And if it's okay with you, I'm just simply using your first name with regard to who has asked what. So again, I do really appreciate you sending this information into us. So let's get right to a 3-gap play. And a 3-gap play, as this indicates here, it's a pattern where you have 3 gaps, and the last gap is called the exhaustion gap. And the exhaustion gap, what is very important about taking a look at these 3-gap plays, there's always a little something that make a pattern a little bit unique. And so this is one that you certainly want to be looking for when you see gaps inside charts. That last gap should be the largest of the gaps. Now, what's important when you do see this pattern set up is that typically what will happen is this will move back to the last gap. As far as who identified this pattern first, we're not completely certain. I know that I was taught this pattern by Tom and David White, and they were taught this pattern by a guy named Tim Ord. I'm sure if you Google Tim, you'll find this exact definition, and it's possible that Tim learned this information from Larry. I forgot to ask Larry that when we were talking earlier. So in any event, there is a 3-gap play. What's most important is the 3-gap play, how you use it, what you look for. So what we've got up here on the screen right now are the Dow Diamonds chart. And what you can see, what I have identified for us is, in this case here, coming up from the October 4th low, you can see that we have a gap here. And a gap, folks, is where if you take a look at, and there's different ways that people identify gaps. I take a look at the gap as just simply any price spread between the high and low of 2 candles, or the low and the high of 2 candles, depending on whether you're gapping down. In this case here, and I don't because I'm on the copy of this versus the live chart, I don't know which date it is. Looks like October. That's 4th, 5th, 6th, possibly the 7th. So between this candle and this candle, there is a gap of price. We then have a second gap, which occurs right in here. It looks like right around the 19th of October time frame. You can see the size of this gap, relatively small. You can see the size of this gap, a little bit larger. And certainly the gap that we had here, this last and final gap, which went into October 27th, and we had gone short here in the marketplace. We didn't get stopped out because we were using the average true range and a multiplier of that, and we were still inside our trade, even though this was the 26th. This is when we were expecting the 17P index date to come in. It actually came in 1 day later, but we did have a third gap, and you can see how that was larger. Now what's important to understand is that after you've had this exhaustion gap, what then typically happens is it will eventually come back to the first gap. And if you take a look at the diamonds, you can see that's exactly what it did on the day after Thanksgiving. It actually closed that gap. I believe that on this day here, it was just shy of closing that gap, came right back down there, and boom, voila. Now, obviously what we do have in the markets today is we have 2 gaps. It looked like to me that there was a possibility in overnight trading as we were trading into the 2:30 a.m. time frame when we had the Dow up 100 plus points and up and over the October 27th time frame it absolutely looked like we might have a gap up. And so I'll quickly go to the question here. I did put into this morning's newsletter at 7 a.m., and what you have to understand is, many times I'm sending these newsletters way out in advance, as I did for today's newsletter. I sent it out last night, and many times, for me, this is really all about pattern recognition. What we trade are really patterns, and it's relatively easy to go out, take a look at what patterns are going on into the marketplace, because we're projecting some of that information into the future, and then when those patterns hit, we go ahead and we pull a trigger. And at 7 a.m., even though there were some other patterns that were completing, it looked to me, in the way that these markets have traded, it looked to me like there was a possibility that they would try to push this market up. When we got into the open, and what I didn't want to do is I didn't want you to necessarily buy right at the open. Oftentimes that first 30 minutes, which I call the opening range, really sets the pace for the day. That's when in overnight trading, you simply have so much going on around the world, and so just simply for those folks that were not in the trade, we're just looking for them to be able to have a better entry point. And so that was the reason why I just simply suggested that. At 7 a.m. you got to make the call that you can make. So there is the possibility that tomorrow, or there is a possibility that on Friday, we see this cycle here play out again, where we would have a third gap up, at least with regard to the diamonds. When we take a look at the other indexes that are out there, you can see that they are struggling compared to the diamonds because they're just really trading at the 0.618 areas. So this is the three gap play that is out there, and I hope that helps you guys. I'm going to move on right now to the three drives pattern, and I have sent out over the last couple of weeks. I've identified three drive patterns as they are occurring, and have sent out Twitter alerts and then followed up with some newsletters because we have different folks that trade different things intraday. And three drive patterns are, and this is the chart. This is a copy of the chart, the specific chart that I was looking at when I probably sent out a Twitter alert on the Euro-US dollar. I think it was several days before that when I sent out a similar type of alert on the dollar index. And what you're looking for with regard to three drives, and this is, I'm trying to show you what I look at so that maybe if you use this tool being the Ensign Windows software program, then there is a application on there that automatically draws the expansions and contractions between swing points, and this is what it looks like. You can adjust the system so that it is more sensitive or less sensitive. Where I have things identified in my system seems to work best for me with regard to a noise filtering standpoint. So if you can picture, I have several screens in my office, and can have many charts on each of those screens that I would be paying attention to for us, looking for possible trade setups. And so as you can see, in this case here, as soon as I saw this 1.272 expansion come in and notice that we were at a 0.786 retracement, to me that is, and what I could visually see here is I could see a Gartley pattern. So I could see a Gartley pattern, this being your X point, your A being up here, your B being down here, your C, and then the D. And this was a little bit more than a 1-to-1, A to B equals C to D. But what we had coming is we had coming in at this area, at the 786, and what was also nice is we had a 618 retracement when we had this first 1.272 move. And if you take a look at from here to here, this is a butterfly pattern. So you have a butterfly pattern, even though it's not a 1.272 from this swing point down to here. Visually, I think that most folks can see that this is an expansion of this swing point. And you had this come in at a 0.618. So even if you played this as a butterfly pattern, you can see how it also worked. Excuse me. So it also worked. And you can see how this retraced, at least with regard to from this swing point, retraced back up to the 0.618 of that. I would imagine if we measure from here down to here, what we'll also find is this very close to the 0.382, which is what you typically expect. The pattern here then went on and failed, but when it failed, it came right down and created a 3-drive pattern. The distance between this and this and this and this should be relatively similar. You can give it just a little bit of room, but you don't want to give it a lot of room. And so when you have a 3-drive pattern to the bottom or the top, if you will, coming into a what also is a Gartley shape, as well as coming into a 0.786 retracement, it's a no-brainer in my standpoint to go ahead and pull the trigger and go ahead and take a trade. If we take a look at what it actually looks like in color, this is a close-up, if you will, of that same area, and you can see what you had, the nice 1.272 expansions. You can see that it was off just by 2 bars coming into it, so it actually peaked early. And which is still not a problem. You just don't want to be in a situation where you are forcing the way that the 3-drive pattern looks. Here, obviously, the next chart where I show the Gartley and the 3-drive pattern. This is what, that is the same chart there on the euro with regard to a 3-drive pattern. I do have one more chart, and this is the chart here that I was noticing this morning as I was doing the radio shows. I had, and these were the euros. There's a few folks either on here or listening to the webcast, and there were some charts that I believe I included, and yes, I included this in last night's newsletter that was sent out, where I identified on the euro 2 patterns, 2 ranges. There was this Gartley that was setting up, this darker yellow Gartley that was setting up here, and then there was a larger Gartley that was right up about here, which was also, I believe, the 0.618 retracement of this move from the top here down there, and it set up the range. And when we came into this area, with a very small ranged bar. This also sent the Dow over its swing point, and as soon as it started moving below the swing point, knowing that the bar, as we came into this area, this would have been a place, if you were up at that time, where you could have gone ahead and placed a short position on the euro, again on a 30-minute chart, and you would stay inside this time frame. What the euro still is doing, it's still a valid pattern. This is a projection pattern. Sometimes they work and sometimes they don't. But the idea is to really be able to draw patterns out in advance so that you're planning ahead of time. And if the market were to move down into this area, it would have to move down relatively quickly. From a timing standpoint, this here, as I've drawn it, is basically, as you can see, is equal. If this pattern doesn't set up, it just doesn't set up, which is not a problem. But here is how you would, in advance, based on taking a look at patterns that are out there, go ahead and draw a 3-drive to a pattern. And what you will see is this is just a little bit over the 0.786 retracement from this X swing point to a. Here is the price point that was looking at, which is 133. On the euro on a 30-minute basis, which means that this would happen in overnight trading. I don't have the exact time on it, but and I'll update everyone on this chart in the newsletter tomorrow or at some point in time, whether it works or it doesn't work. With regard to other questions that were also out there, let me go back to the question sheet here. Let's see here. Question about new subscriber wanting to take a look at PVX, and also a question about trailing stops. So let me get to both of those here next. We're doing pretty good on time, so if I seem like I'm rushing through it, hopefully it's reasonably enough, so I'm not rushing through it too much, so that you're able to take all this in, because I do want to be able to open up the floor to some questions or go take a look at some live charts. So let's take a look at the question about trailing stops, if you will. And, this is my philosophy on trading. And not that I don't use trailing stops. I like to use trailing stops I prefer to use trailing stops when a pattern has completed and the pattern might continue to go on beyond that. But otherwise, in playing the pattern as much as possible, I will adjust stops and move stops up at times. We're dealing in obviously in a very volatile market. But the way that I take a look at it, if you really take a look at the golden rule of trading, and I break it down this way, and this is the same transaction, just taking a look at in two different times. There's the thought process that, in this case here, let's assume that you bought 300 shares, you entered at $30, you had a stop at $28, and let's assume that you, in this case here, I'm just going to use this, that you move your stop up from a trailing stop standpoint, because the question was, only doing a portion of the position at a time. And let's say you put in a trailing stop and it ends up taking out at $32. And the stock moves on and then takes out, comes back and takes out from a trailing stop the next thing at $35. And it moves up and it takes out the last piece at $45 here. In this case here, when you simply, now at risk, what I want you to understand, when we took this risk, what we risked was 300 shares and a $2 stop. So we were risking $600 on the trade. And that was our risk. I'm assuming here that is also 1% on the trade that we would have out here. And there are also questions about the 1% and how we use that. So the risk is $600, and if the full pattern of this trade, such as on a Gartley, where you would say, okay, we're going to go ahead and start taking profits at the 0.618, or we're just simply going to take all the profits at the 0.618, or the idea, the thought process is, what you want to be able to do is you want to have the full pattern projection, because in this case here, you've got all the risk at 600, and you start taking profits out, and what your reward to risk you end up getting, is 3.6 to 1. Not that that's bad. But if you're trading the patterns, such as the Gartley or butterfly, you're trading swing point patterns, then what you really want to do is you want to do just the opposite. If you were willing to risk $600 on the initial trade, you want to let that pattern really complete. And when you do that, that's what's going to give you the higher multiples. And you'll see this as we get into markets that become less volatile over time. What you'll see is you will really increase your expectancy in your expectancy table by letting those profits run. And when you get to the full pattern projection, that's when I like to use trailing stops. So it's just a matter of, I accept the risk when I enter the trade, when I know it's just 1%, not that that's insignificant, but I know that I'm risking 1%. I need to think I believe that how we should think is we should think with regard to what is the full pattern projection as much as we possibly can. So hopefully that answers that question. And if not, let me know, and we'll go through it further. There was a question also about just simply adding to positions, and my thought process on adding to positions. I do like to add to winning positions because of the jerkiness of the market that we have right now. We just haven't been able to find long enough runs to be able to, and with all of the gaps and everything, we haven't been able to find long enough runs and enough conviction, in my opinion, to be able to find trades where we can truly add to positions. Sometimes what we'll do is we'll take a look at as we might be in a trade. Let's say it's a Gartley pattern, if you will. Let's say it's a 3-drive pattern. Say this were to complete, and when we get to the 0.382, you might see a nice long spike up. You might see a gap up into your 0.382, that first area, and see very little pullback at that stage. Then it would make sense to add to your position, because it would tell you that you're likely going to go to that 0.786 area. But we just simply haven't had the marketplace where I've been able to see where we've been able to really add to positions, but we will be in that marketplace. We're just not there right now. The question about the entry on the PVX, this was for a new client that had signed up and was taking a look at this stock, and this is something we may even go ahead and take a look at from a newsletter standpoint. I haven't investigated enough. One of the first things that I do when I take a look at any stock, ETF, currency, anything that's trading, is I try to see if there's any patterns that seem to be consistent and ongoing. And in this case here, when I pulled up PVX, what I was able to visually see is a number of A A to B equals CD patterns that we're completing out there. Once you find a pattern that seems to be fairly consistent inside a stock, then you continue to play that in that because each stock, if you will, has a what's the word I'm looking for? Has a personality, just like each of us do. And so once you can start to understand the personality of what it is that you're trading, you want to be able to trade something like this versus something that's schizophrenic, right? And so in this case here, what you can see is you just have a 1-to-1 A to B equals C to D. You can see you had a 1 to 1.272 A to B equals C to D. You have a 1-to-1 A to B equals C to D. It completes, it pulls back. You have a 1-to-1 A to B equals C to D, and it just had completed this 1-to-1 AB equals CD pattern that is out there. And you had this nice volume spike up here, and so that is really the first thing that I do. Then I start taking a look at, any other candles that are out there. If you can see this here, you have an island reversal candle. As it moved down in here, you've got a candle that's all by itself, gapped up, and you can see that that's indicating to you some strength. When the stock pulled back into this area, this happens to be a 0.618 pullback. I think I might have that on this next screen right here. And so what you can see, so here is that island reversal, if you will, as it was pulling back. And what you can see, here's your A to B equals C to D. Here was your last gap up, your last sign of conviction. You had a gap up prior to that. And right now, I'm sorry, let me just come back here. You can see that this has pulled back. This is the 618 of the move from here to here. So I just tried to clean this chart up for us a little bit. You can see also the move from here up to the top here, how this pulled back to approximately the 0.618. So another personality of this stock is pulling back eventually to a 0.618 area. The question was, where would you want to take a look at possibly getting long on this? And that's really the 618, which is in this 929 area. You've got this bullish engulfing, so the top of this should act as a support area. I think this is $9.22. And if you're coming back into this area here with volume lighter than this specific candle, I can't recall what the number was. I think it's around 800 million shares or something like that, or 800,000 shares, not 800 million, 800,000 shares, then you would want to take a look at going long on this. So I'm going to investigate this stock a little bit further, and let me see if there's any other chart that I have on this. This is just simply the closer up view of PVX, so that you guys can see this and take a look at it. But initially, I didn't go back far enough to the left-hand side of the chart to see what was going on there. Let me see what else is it that I have here. That is, and there's our 3 drive. There's another 3 drive. I think that was the original one. So let me go back to the questions here, and then I'll open up the floor to questions. It's 342, and then we can go to some live charts and just see what. So we've taken care of PVX. We've taken care of the trailing stop release. I've tried to answer that. Okay. Let me come back to the 1% and the ATR. So Ed was asking a question about how the 1% rule works. And so let me just go ahead and pull up the position size calculator. I think I might be able to knock out 2 questions at one time. So let me pull that up here for everyone. And the 1% rule goes like this. What you never want to risk more than on any one trade. Now, we might add to trades because we've got some profits, but in your initial trade, you should not risk more than 1% on any trade. And that 1%, and let's just happen to say we're taking a look at the SPXU. So we'll go ahead and do that. We'll take a look at something that we're actually in right now. And the way that you use this position size calculator, you input the symbol that you're trading, you hit search, and it'll tell you just to make sure that you have the proper instrument. In this case here, this is a index ETF, meaning that we're dealing with the S&P 500 versus a stock or a sub-index. A sub-index would be, let's say, one of the 9 sectors of the S&P, such as the XLF or the XLK or any one of the other sectors inside there. So we're dealing with an index ETF, and in this case here, even though this is an inverse ETF where you'd be going short, we, for our calculation purposes, would be going long. but this is an inverse ETF, the Ultra Pro Short, which tells us. Now, the 1% calculation is where you just simply put in your available trading capital. And so if your available trading capital is $10,000, we'll put that in. This automatically defaults to 1%. There are times when I send out trades and suggest maybe only using 0.5%, but 1% is usually a pretty good place to start, 1% or less. Now, when you hit the search button, the average true range is automatically calculated for you. So the question about the average true range, if you use the position size calculator, input the symbol that you want to trade, hit the search button, it'll automatically come back and populate it. The detail for your positions, for your average true ranges, are all contained down here. Now, we had a holiday with it being Thanksgiving, so we're only taking a look at 9 trading sessions. Once we work through this cycle, we'll be back to 10 trading sessions. And this happens to identify for you whether or not you've had gap ups or gap downs, GD for gap down, GU for gap up. And this helps you to understand what the actual average trading range is, which is the same thing as saying the average noise or the volatility of the instrument that you happen to be trading. So when you take a look at the 1%, just want to make sure, the 1%, let's go through and do a calculation here. Let's complete this thing right here. And I don't remember the numbers off the top of my head, but let's just say that you were going to enter the SPXU in the closed yesterday. We're at 1340, trading right now at 1320. So let's say you were going to take the trade right now, 1320. I don't know where our exit is on this. I'm going to assume it's somewhere around, I'm not going to assume anything. I'm just going to put in $20 so that we can complete these calculations, and I come back here and talk about it. Once you enter those last two pieces, you hit the calculate button, and then you can go all the way back up to the top, and it gives you really all the information now that you need to know. Again, it finishes the calculation, so 1% of $10,000 would be $100. If you had $100,000, 1% would be $1,000. You're only risking $100 on a trade, or you're only risking $1,000, whatever that 1% is. That has nothing to do with the actual stop or the percentage of the stop. The stop is then the second calculation. The second calculation is taking the average true range. In this case here, again, that was calculated at the bottom on a per-day basis over a 9-day session, and we are multiplying that times the Fibonacci expansion number. The reason is we don't want to really enter a trade and use the average true range, because we could be right on the trade, we could be wrong on the timing. We could enter a trade 1 day early, 2 days early, whatever it might be, and we're still in the right trade. And during a volatile marketplace, you want to make sure that you're outside of 1 times the average daily noise, the average up and down in that equity. And so what we use is 1.618. When I started teaching this to folks at TFNN, what I didn't have this position size calculator. What we were using was we were taking a look at the weekly true ranges from top to bottom, and I was multiplying that times another Fibonacci expansion number, 2.618. That was really multiplying times 2.7. It was just a little bit easier than somebody trying to multiply times 2.618. I like to use Fibonacci expansion numbers when we get to a marketplace that'll be a little bit less volatile. If we get into a bull market with less volatility, then we'll go ahead and we'll back this down to 1.272 most likely. If things get really volatile, we will increase this beyond 1.618. That tells you what your stop on the trade is. And then you're just simply taking your risk, 1%, divided by the stop, and that's going to tell you how many shares that you should buy. In this case here, 85 shares per $100 risked. So I hope that clears up that question. But if not, send me an email. Let me know. I want to make sure that that the light bulb goes off, because if there's nothing more that I ever teach, if you take this, you'll be able to walk through the stock market and make trades so easily. Now, if you're trading somebody else's system, I'm not doing their stop calculations. You can at least understand what the average volatility is. If you want to use somebody else's or you identify your own stop, then it's a very simple thing to do. I just recommend that you come here and for your average daily true range, you just simply input whatever your stop might be. And let's say in this case here, maybe it was $1.50. Whoops, so maybe somebody said use $1.50 stop, then for your multiplication factor, use 1, because 150 times 1. Come back down here, hit your calculate button, and then that'll tell you how many shares that you should buy for the trading system that you're using. For those of you that subscribe to Basil's newsletter, oftentimes he likes you to take a quarter of a position, and so it becomes very easy. If the maximum that you should be risking on a trade is 1%, just simply come back here and make that 0.25, if you will, and then you will be able to, and let's assume that these were his stops, then you will be able to go ahead and identify how many shares you buy, and simply round this up. Don't buy 17 shares, buy 20 shares or some whole number just to make it a little bit easier for you. Let me go back to the questions here and see what else. So now I need to come back to Hal. There's a question from Arash about understanding why currency markets, the volume isn't helpful. There is no one single exchange where all the currency, the $4 trillion that is traded on in currencies that are traded in the marketplace, where it comes through one central clearinghouse. Many times, all of my trading is done for currencies, is done through interactive brokers. It is pretty much done in-house, if you will. And so if you're trading currencies and you just simply see a volume bars up there, just turn it off. It really has no significance, no consequence, nothing that you could truly trade off of. What you want to do, and what I will be teaching you over time, both through the newsletter and other ways from a currency pair standpoint, all that we want to pay attention to are the patterns that are out there. And we want to be patient. We want to wait for Gartley and Butterfly. We want to wait for those expansions. We want to look for those 3 drive patterns. And we want to stay inside the scale that we're using. If we're on a 10-minute chart and a pattern sets up and you're going to do your reward to risk, you do your reward to risk on that 10-minute chart. And then you can go ahead and put trailing stops in for sure after your pattern's complete and let it move further in that direction. That takes us now down to Hal. 351. Boy, I got a cruise here. So with regard to, there was a question about Hal. I think I have that on here. If I don't, we can go right to it. I don't have it. So let me go to the charts, see if it's still up here. And it probably isn't. One quick question. Maybe I do have it here. Oh, maybe we already covered that. Okay, I think we might have already covered that. And if not, I'm confused now, or I'll answer that question afterwards. So we don't have much time. Why don't I just go ahead and quickly open up the floor, because we've got about 4 or 5 minutes, if you will, and let's go with that. I did answer. Okay, great, thanks. So what other questions? Let me see what anything's been written here. So we covered this morning the opening and what I threw out there. Ron, with the lunar cycle this weekend, do you reckon taking additional short positions on Friday? I'm going to have to wait until we get to Friday and see how things are trading. I'm just going to simply have to wait to Friday at this stage. Multiple factor market volatility was the key for me. Okay, great. Thank you. You answered Hal. Steve, what is OPC and how to read it? OPC, what are you referring to? Rose, could you help me out there maybe a little bit? Any other questions as well? Let's see, put call ratio. I don't use the put call ratio, Rose. So I would be I couldn't apologize, but I could not give you a valid answer. It's not anything that I use for an indicator in trading. In trading any stocks or currencies or futures. Apologize for that. Just hasn't the patterns that I trade seem to work good for me. Where do you get all your energy? Don't have much energy, Christy. Many say that smart money uses it. Yeah, again, there are so many different trading systems that are really out there. I know the results that we're getting in our trading system, the expectancy, it's going to fluctuate a little bit. Quite frankly, the trading expectancy, if we're in a bullish market, not being jerked around as much, would actually be higher. We would really be able to let our profits run in there. So I'm comfortable with with what it is that I've got. And anyway, so let's see how about some other stuff. Sorry about that, Rose, but that's since I don't use it, there's really not too much more that I can really comment on it. Now, one of the things that I have been doing, as you know, because of the correlation that's going on inside the marketplace, you know that the newsletters have really been focused on the currency piece of trading here, and so I hope that that is helpful to you, and that you're that you are appreciative of that correlation, that we see out here. This is the correlation, if it will come up on my screen here in a moment. And so there is that direct correlation between the dollar index and the markets. And again, as long as that correlation is in there, and because the currencies, are trading, all day, all night long, it's really helpful to understand what's going on. Gartley sell on SPX 2-day, 10-minute. Nick, let's see. 10-minute chart. And so let's see, we've got Gartley sell on SPX. Make sure I got it. The number of days, Gartley sell. Looks to me, at this stage here, is this what you're referring to? Because right now all we've really had is a test of the top, if you will. I see an ABC, but the Gartley sell would have probably come in right here. So that would be that would have failed. Let's see. Okay, guys, look at the dollar index. Came in late. Are we looking to maybe be going down here? And will there be any ETFs by Zen? Again, I'll continue to, we're unless we get stopped out of the current positions that we're in. We've got obviously 2 shorts and 1 long. Position from a market standpoint. I will be looking at other, I'm always looking at other ETFs. I have not found, the only other pattern that I found out there from an ETF standpoint, quite frankly, was the XLK, and I have been looking at the Qs. Was kind of hinting at that this morning, or in last night's newsletter, I should say. And I'll pull that up here right now. Let's just even see how this is trading. Of all of the sectors inside the S&P 500, what we're dealing with here, and this is really what I've been paying attention to, this high volume bar out here. The XLK, the technology sector, here is the swing point from October 27th. You can see there's 13 million shares, and it came into it and tested it with 6 million shares on the 5th, tested it yesterday on 5.8 million shares. Today, God, is this volume right? 1.4 million shares. Holy cow. That is nothing. Wish I would have tested it up here. But the reason why this trade has not shown up is because I'm watching how it handles this high volume bar right here. And you can see right now, and this is a big buyer, a big seller that is in there. So in any event, it's 3:57, and the production guys have got to get ready for Tom's shows. And I will get to any of your other questions, or send me an email with your questions, and I will get back to you. Folks, thanks so much for being here, and have a great afternoon. Okay? Take care.